Hi everybody, my name is Mary Redmond. I'm talking right now about the Australian dollar US dollar pair. So following the last couple of weeks dramatic volatility when the pair dropped 1,000 pips, we're seeing a retracement this week, and the retracement appears to have stalled just short of an important Fibonacci level at 106.34, which corresponds to its 50-day moving average. So I have a small short at 105.85, and I would be inclined to short again if it did touch this 106.25 level. And I would be inclined to put a stop in about 107.5, because if it were to clear that level, I think it could probably move back up to the 1.10 level. But looking at a weekly chart of the Australian dollar, US dollar, to me it looks like it's in a downward channel now, after having broken out of its long-term upward trend line earlier. So what we're really seeing over the last couple of years is an incredible growth rate in the global economy, as well as the quantitative easing by the US Federal Reserve, which pumped a lot of liquidity into the markets and stimulated the stock market. We've also seen an incredibly strong growth rate of approximately 9% annual GDP growth rate from China, which is really the key driving factor for Australia, since most of what they export, a great deal of it, goes to China. But what we're seeing now is those factors changing, and the RBA mentioned that in their minutes, their latest minutes from the most recent meeting. They said that they do see they expect to see a slowing of global growth in the second half of 2011. And this is due partly to the fact that the U.S. economy is only expected to grow around 2%, and the Federal Reserve is not expected to start another round of quantitative easing, unless there are really extreme circumstances. Plus, you've had the Chinese raising rates extremely aggressively from the 2010 to 2011 period. And some of those rate hikes are just beginning to be felt, so it's possible there could be a significant slowdown in growth coming from China. And you also have the problems stemming from the EU. So the RBA, the Reserve Bank of Australia, did mention these European problems if you look at their discussion of the financial markets. Then they discuss the rescue package with Greece. They go into the details of it, but the basic gist of what they're saying is there's still a concern about rising sovereign yield spreads, and their concern over increasing Euribor or LIBOR rates, and whether or not that could cause a credit crisis going forward. And this isn't something that just the RBA has mentioned. It's something, if you look at or you read, it's something that all of the central banks, the major ones, have mentioned being concerned about at their last few meetings. And you can even look at the Bank of England's report. Just recently, the Bank of England has come out and said that they see increasing headwinds to the global economy. They cut their economic growth forecast. They voted unanimously to keep rates lower, and they might even start quantitative easing again. And Mr. King of the Bank of England had said that some of the biggest risks to economic growth come from the Eurozone, and the risks have the potential to have a significant impact on the UK economy. And the Bank of Canada has said this, as well as, of course, our Federal Reserve, which they are continuing to monitor this situation very closely. So what the 12-month Euribor rate is one of the things that's important to watch to get an idea of the concerns about the Eurozone. And you can see that it's had a significant spike up from the year ago period. And it's actually a little bit lower than it was in the middle of the late July, early August. But it's still spiking up from its low levels, and it's still a concern. And if the Euribor rate remains elevated and the sovereign yield spreads remain elevated, then it's a real concern that the impact of this is going to affect credit markets all over the world and slow global growth and potentially cause a credit crunch. So with that as a backdrop, we also have a situation in the stock market, and it looks like we've had an incredible bull run over the last year. A lot of that is the impact of the Federal Reserve's quantitative easing. So now that there's less liquidity being pumped into this market, you can see how much harder it is for the markets to sustain a real rally. And after this 1,000-point drop in the Dow, you can see that the 1,000-point drop in the Dow correlated almost exactly with the 1,000-pip drop in the Australian US dollar. It's really struggling to regain that. It's regained about half of what it lost, and it's really kind of struggling at these levels. And we've seen over the last couple of days failed rallies in the market, which usually precedes a more significant drop. So you can see here, if this stock market rally stalls out and it makes another retest of its lows, that would probably indicate that the Australian dollar, US dollar is going to move down also. And the other very important technical indicator to keep an eye on when you're looking at the Australian dollar is the volatility index. So since the end of the quantitative easing, we've seen an increase in the average trading range of the VIX, and we've seen it quite dramatically. These very low periods were good periods to sell the Australian dollar, and these correlated with periods to buy the Australian dollar. But now we're seeing an increase in the general trading range of the VIX. So when it spiked up here and you had these massive spikes, the Australian dollar US dollar pair hit parity, and that was a good buy. Now we're seeing a retracement, and there's no exact level at which you know when is a good level to buy or sell, but using the VIX and the stock market, sometimes you can get a pretty good indication of when these rallies are starting to fizzle out. So I'm inclined to short it here. I also think that this cross here, which is a 10-day moving average cross below the 50-day moving average cross, is a very bearish sign. And also looking at the Ichimoku indicator, this looks like a bearish cross. The Tenkan Sen line crossed below the Kijun Sen line. And you can see that this is a cluster of very heavy resistance here. So it's going to take a lot of strength and a lot of momentum and a lot of risk appetite for investors to bid the Australian dollar up into this region. Of course, that's always possible, but the latest market crash kind of spooked people out, and I think that there may be a reluctance to go ahead and buy stocks and buy these assets which are considered riskier when nobody really knows exactly how the situation in the EU is going to play out. So that's what I'm inclined to do here. I think we'd have another move down in the Australian dollar, and I would look for a very big spike up in the VIX before I would want to buy it.